Hi everyone, this is my evening rant for Sunday, the 17th of February 2019. An interesting week because we closed down after having touched the 11,100 mark last week. And 11,100 was important because it was 61% of the entire fall that we had seen between September and October. So, having done so, the big question on your mind should be, is this the start of a larger move? Are we still fighting that range bound activity that has been going on? Well, on Friday, we closed right, above the key level. If you draw a trend line of all the lows from December, that level was around 10,675. And while we came close to it, fell below it, but we didn't really close below it. So that leaves the debate open as to whether the range breaks. The weakness in, of course, stocks and the broad market has always continued to indicate that this would happen. But as we saw in the month of July, and that's, I think, the main thought behind believing that maybe this time is different. In the month of July, you saw a sell-off in the broad market, and the index did not follow it up with hitting a new low, and eventually the market ended up rallying. Now, one of the themes of that point of time was that our market itself, in terms of some of the indicators, at least the FIA data, FIA positioning was at the low end of the range, which means they were almost 98,000 contracts short in index futures, and there are at least a couple of bottoms that have occurred since 2012 near the 100,000 mark. So we got close to that. We also got close to that again in October from where we have rallied. But right now we are nowhere there. Every time the markets declined in this trading range, you see some selling come in from FIs, but then they end up covering that position, which is exactly what happened post expiration this month. In fact, they ended up being long after the events, that is the budget and the policy, up to almost 50,000 contracts, near the top end of the range for the last 6 to 8 months. And from there, on Thursday, we got a sudden sell, which means they sold almost, I think, 3,000 crores of index futures in a single day, which is a pretty large number for a single day, something we've not really seen happen for a long time. And on Friday, we saw some follow-up selling, another 1,000 crores odd, somewhere 900 to 1,000 crores odd being sold again. And so we'll be watching whether that trend continues. So that's brought their position back from 50,000 straight to zero. They are marginally short, nothing significant, but at the same time, there's a lot of room on both sides to really say that this is a extreme situation of either, at least not of what we have seen at bottoms. And we can look at many other data points. None of them are at the low end. And so back to the main question, then, are we ready for a move? Now, one of the events that has taken up the entire mind space in the last couple of days has been what has happened at our border. And I don't think I've seen this kind of an outcry in a long time, where everyone's talking about going back and doing a counter attack, and there are protests. It may partly be reflective of the social mood of the moment, and that's where probably Elliott comes in to actually reflect on what has been going on in the underlying, because we've had issues before. I don't think you saw this kind of an outcry even before the URI attacks that really happened a couple of years ago, or even if I go back to Pokhran and the subsequent Kargil war, that time too, there was a lot of negative mood. But post the Kargil war, you actually saw a rally, but the sell-off actually occurred after Pokhran, so that was probably the trigger point for whatever happened at that point of time. So what are we going to see now? Now, while it might seem apt, if you really want to quell this issue, that you are able to pinpoint where the terrorist forces are located, and then you make an attack to actually wipe those out, those could be among the most meaningful options. But if that option involves infiltrating the borders, you essentially would end up escalating things into a war. Now, here's where the Elliott Wave perspective comes into the whole thing. When do these things happen? So what I'll include along with this video, if you're getting the email from the newsletter, then I'll include two links. One is, of course, a video to one of the Elliott Waves International's videos discussing equity markets and wars and the psychology that involves, and one of their articles from the Socionomics Institute also discussing the same. But just to give a highlight of what they're trying to say in all of that is, it's a very detailed study done, and I think it was published in their original Socionomics book set, and later on in the new book that they released, which is the behavioral, the socionomics study of behavioral finance. So, uh, in that book and in the earlier ones, and I think in various posts, they've discussed that when do such outbursts really happen? So when you enter a cycle degree or higher third wave, and essentially wave C of a bear market of larger degree, then the social mood turns negative enough to actually trigger these kind of events. And it need not be necessarily war, it could also be social unrest, civil unrest, or some kind of domestic issues like the ones you're seeing, like the yellow vest movement you're seeing now in Europe following their third wave, which has almost been around for almost 8 to 9 months. And so would the same also be true here? The only difference is that it appears a bit early in the trend, because we're in the process of starting a third wave down in India for quite some time. It's really not kicked off. And the same in the Pakistani market. The Karachi index completed wave B and has been attempting initial impulse waves for the third wave down. But they've really not gone into a major decline, but the indications are there that at some point the third wave has to kick off. The study originally done showed that in most of the cases, except I think one, uh, the outbursts in terms of the unrest or war situations that occurred always occurred at near or end in the last stages of the third wave. So they either started in the last stage, so therefore markets initially fell as the last wave of the third wave completed, and then they recovered from there once the attacks and other issues really started. So in many cases, it looks like when the attacks start, the market actually goes up, and that becomes one of the notions that you actually hear, that whenever there's a situation of this kind, markets actually go up and not down. But that's not necessarily the case, as you will see in the videos and material that I'll post out, that the timing varies. But all these events occur because of the negative mood that follows a third wave or a C wave of a cycle degree or higher bear market, because of the negative mood that it really involves. So it starts either with the third wave starting, in most cases after at the last stages, and in some cases, like in case of World War II, actually after the recovery. So which means markets recovered, and then they went into a wave 2 decline where the mood was still bad, and by that point of time, you actually got World War II getting triggered and Hitler becoming the center of all of that. So these are different stages at which it occurs, but the cause factor is main, is the negative mood involved with the third wave down. So we were at the starting point. In fact, I think it was, I don't know whether it was the long short report of, I don't think it's the Jan one, probably November or December, one of them. I did mention that when you do start the third wave down, this is what the risks are. And I would have thought that, well, if we are starting the third wave down now in Jan or Feb, then these kind of risks could show up 5 to 6 months down the line. So I'm a little surprised that they're showing up now. Will it really result in uh, uh, you know battle lines being drawn, or is this just the early stages of escalation of more tensions in the months ahead, is what we will see. I think probably the second, in my understanding so far, but once you start moving in that direction, it's an escalation, and things could just keep getting worse if you get involved into border tensions at this stage. So that's my take, and you will get more insights from the other material. So one of the other articles that I just read yesterday, and this was again a little peculiar because it came from a well-known analyst, Saurabh Mukherjee wrote this note, and I found it on Twitter, talking about the index not being relevant anymore, which is very, very unusual, because the index is really supposed to reflect a large part of what your economy is doing. Now, just because a couple of sectors like the heavily capital intensive sectors are part of it, that doesn't mean the index becomes irrelevant. In fact, it's those sectors, the capex cycle not picking up, that is your biggest issue. The lending growth, credit offtake not going in a particular direction. So should you really change the components to reflect just those sectors that are doing well, and not the entire economy or the market cap as a whole? Should the choice of these stocks be based on turnover, or should it be based on profitability, or should it be based on the GDP? So what should the index really reflect? And I'll tell you, this kind of talk, the last time I heard, was on a very, very similar situation where you had a very, very narrow bull market, and you go all the way back to Y2K, the tech bubble. At that time, they were called the I stocks, which means I for information technology, C for communications, and E for entertainment. Those three sectors became the most touted sectors, as though they were going to be the center of India's growth cycle, and none of them significantly formed a part of the index, which is why when you got the tech bear market, The Nifty actually did not break the 1998 low in 2001, whereas the Sensex did, because at some point when they included some of these tech stocks, well, the upside was not so much in these indices. They didn't run away very far. The downside got aggravated because of the inclusion of these names, and many of them fell very sharply. It took many years for them to even come back to the same price. You take the example of Z or Infosys. Infosys took almost 7 to 8 years to come back to the same price it was in 2000. Z took even longer. So Z did not even come back to those highs till I think somewhere in the 2010s. And there were many other smaller companies that got into speculative runs because of the Ketan Parekh involvement, and many of them went down by 90 to 80%. NIIT would be one of the still listed good companies that had gone up a lot. The stock was almost $1,000, and post 2001 dropped by 90% within 3 to 4 months back to almost 100 rupees. So these have been many of the instances, and at each of these times we heard the same thing back then, that these are the sectors that are the future and they should be part of the index. Whereas the real boom really came on a broad economic cycle that started from 2002, where sectors like power and those in cement or capital goods, all of them actually did very well. Completely new areas did not really become the power runs of the next growth cycle, because what you really needed in India at that time was infrastructure. And once the infrastructure boom took off, everything that was related, whether it was goods producers, big companies, BHELs of the world, whether it was the ABBs and Siemens of the world, all of them really did exceedingly well after that point of time. And so it was always back to the brick and mortar stocks, which was one of the takes I had, I think, prior to my joining Sharekhan, and even after that year, that there would be this complete shift away from one segment back to the core economy, because they had spent 6 to 7 years consolidating. Now, that's a similar thought that has been thrown at me even now. So since many of these sectors have been underperformers for the last 5 to 6 years, are we at the end of that cycle and now they are ready to pick up? The idea should have been the same, but what they have not really gone through is the deleveraging process. So back then in the year 2000, we wouldn't have been at an extreme situation as far as leverage is concerned, because the debt to GDP ratio on the government side and the private side combined were not this high. The government side had gone up, but the private side was much lower. It was less than even 50%, which is now almost at 100%. Non-government debt to GDP is at almost 100% of GDP. And so if you want to really start off the growth cycle all over again, you have to go through this process. We are in between it. We've at least recognized the problem, whether it's credit growth, the NPAs, and a lot of new issues cropping up. In fact, the closest that you can get to making any comparison of this is actually with the US, although I would say we are more where the US was probably 100 years ago, or closer to where they were in 1929 in terms of the demographics, combined with where we are also in terms of credit to GDP, because the numbers would be similar. Also, that our economy is is not a developed economy, but still a developed economy. We have so many weaknesses in so many areas that need to still be developed and built upon. But we've already reached the end of our credit cycle, which is why, to solve all those problems and achieve those ends that we really want to meet in terms of long term for the next generation, you'll have to reset and restart where we are. And it's an opportunity in a sense to really rewrite the rules of the game to what they should be and what we've all been aspiring for so long, that we've not been able to correct simply because of the the past. We have just got the hangover of the past that we've been carrying on, and this corrective process is one way of overcoming it, that you not only solve your credit problems, that is, you just don't have to solve the debt related issues, but when so many companies that are involved in markets in the wrong way have to pay the price for it, simultaneously you rewrite business rules, you rewrite how various parts of our machinery in terms of the government machinery function, and you put in place all the systems and processes that make it possible for the next generation to really take off. So I think that's an entire job in itself, which feels undone over the last couple of years, even though we've been hoping to progress in that direction, and we've been held back simply by the forces of the past, because those who have been involved in the previous business cycle and are stuck are really putting pressure on trying to maintain their survival, which is always the case, which is what happened with US in 2007. They bailed out a lot of people but didn't really solve all the issues. Now it is our turn, because we didn't really have issues in 2007, but now our issues are elevated. We are already facing the music. We have started recognizing problems like we are seeing in the NBFC sector. I still sense that a lot more issues are to come out of each of our banking and non-banking sectors. If they are allowed to, the pressure is to really keep them under the surface, or probably hope that they get sorted on their own, which is unlikely to be the case, or probably inflate it away, in some way. So we can attempt all of that, but even that takes time. So you will either waste time in reaching the end result, or you can quickly sort it out by taking action, which in the short term would involve more pain than we've already taken. So I think those are the simple choices. In the meantime, because you've seen such a sell-off in stocks, even though the index does not reflect it, maybe the social mood has already turned a bit negative, which is why you saw this outburst across the country over this recent activity of terrorism that we've really seen, which is more than just that. And we know that the issue is deeper, but we haven't seen this kind of an outburst for a while, which is partly to do with what we should say is mood of the nation. Now, at the same time, the US market, while we've been seeing weakness in our own stock market, I think for almost 1 month, more in stocks than the index itself, the US has actually had one of its strongest rallies starting from December, and it appears to be moving up on the same news day to day, which means either the trade wars or the Fed speak, because they've already said that they want to ease off and turn a little dovish again. We've already heard that US and China are talking and trying to come up with an end result. But every time there's a news item related to that, the markets say that they're going up on those news events. While how much can you discount the same news event over and over again? And also most of it is known on that front. So probably the media has run out of stories to really run, because having worked for a short period of time in the media, if I was a journalist, I would have to write news every day and have to come up with something to explain why things are happening. And what would I really write? If there's no other news, you probably write the same news all over again. And so it appears like that's the primary reason why what's happening is happening. But the primary reason might be some form of short covering, a certain amount of sentiment change, definitely because of the Fed's change in stance, a 180-degree turnaround. But as we know from past cycles, that as and when the interest rate stances have changed, whether it is for the US or for India, the first rate cut never really brings about change. It takes a couple of cuts to actually turn things around once the economy starts slowing. And we've already hit a slow growth path, not just in the emerging markets or Europe, but also now in US. US has now a couple of months of negative data flowing in from various segments, whether it's retail sales, housing sales, or it is industrial production. All of those data points are now falling month after month after month. The retail sales, in fact, fell. The growth rate fell to the lowest you have seen in probably 8 years. And so that's something to seriously think about. So growth slowing has become a global phenomena. It's also hitting us to some extent, as we saw with auto sales in December, though they flattened a bit in the month of January. So now that we have a slowing environment, which means expectations for earnings growth remain weak for the next quarter as well, not just this quarter, which means the March quarter as well. And any move up that the markets are making is essentially on hope that things get better, but they're really not likely to anytime soon, especially in our case as we hit the election season. So that sums it up, that there's all the reasoning that's going around the US doesn't really make sense, because when they actually announced trade wars, everyone has already pre-booked their sales, which means that all the orders were booked based on new tariffs coming in. If tariffs are going to be going up, you might as well place your orders today at the lower rates, and that business was done and dusted. Which means that when you actually sort out these problems, which also is not certain that US and China are coming to an agreement, but even if they do and these tariffs go away, then what? Because that was really not the reason growth is slowing. And at the same time, since you've pre-booked, there's no more business to be booked anyway. So it's mostly just sentimental. This rally has been more based on sentiment. but it should be at the fag end because sentiment has reached an extreme. We've already almost on the daily sentiment index hit 88% bullish for the S&P, and previous readings were almost 1 year ago we were at around 92% in Jan of 2018, just before the market peaked back then. So we've reached that level. We were at a similar reading at the October top, around 87% or something, if I'm not wrong. And so you're almost at the same reading now in terms of extremes in sentiment. Most Asian markets have done counter trend rallies, so they should be on the verge of rolling over, as most of the covering or short covering based run up should already be done here, and sentiments already turning to the other side. And still people come and say, well, should the markets bounce here because everybody seems to be bearish and everybody's really just our feel with the next 10 people that we speak to. Because if I speak to people who I'm involved with, or who believe me, they'll probably sound the same, but that's not the entire market. So you really need market indicators to measure what is happening. And you look at something like a put call ratio, it's still at the top end of the range based on the last year's data, and that does not give you an indication that you're at a bearish extreme. Similarly, like I mentioned at the start, the FI data doesn't give you an indication that you're at a negative extreme. So how does all this end? I think I don't know whether it's 1 year or 2 year. Time will be hard to tell. 2 years being the longest bear markets that we've really seen, but we are likely to see a series of events similar to what we've seen in the US when it started with bear stearns. It doesn't end with that. When you're dealing with the credit cycle, it always ends with a credit event, and we've really not had any major credit event as yet. We've just had recognition of credit issues, and so those are probably many months into the future. And at that point of time, credit spreads between the riskier borrowers and government bond yields would widen significantly, put pressure on interest rates, and that would probably mark the end of the economic winter cycle, which may lie ahead. So there are many more events that we're going to face as far as the credit situation are concerned, is my sense. This is purely based on how a cycle should behave, not based on speaking to anyone in the management or their talk, because that's not how cycles work. Cycles are a series of events that follow one after the other, and that's what you have to be on the lookout for. You have to see that the data changes, and once that happens, then you know that it's time to take a call for the next major change to happen. But right now, we are still on the in the winter cycle. It's not really over. We are still somewhere far in between. The markets are still in the process of recognizing that is the real situation, and will probably come to recognize it even more meaningfully in the months ahead, probably once you actually start breaking down from the current Nifty range, even though stocks have already done so. So that's all in this update for this week. Thank you.